what has business been like for you since the property market reopened on the 12th of May? What have you seen? What have you been doing?
Yeah, great. The market's been very, very busy, particularly in the residential space. We found that a lot of people have obviously come off lockdown, and they've had plenty of time to be able to be locked up in their homes to decide whether their homes actually work for them or not. Lots of people making life decisions as well. So there's been the unfortunate demise of relationships where people are obviously separating and going their own ways. But also there have been people who have rekindled their love and focusing on the world and their life and what life is really all about. So people making some big lifetime decisions. And that's really sort of coming out to play in the market, where there's a huge amount of demand, very confident buyers, and people who are looking are genuine buyers. They're not tire kickers going out sort of daydreaming. So the market has been really, really positive, and we've been really, really busy, and it's sort of trying to balance up that whole is it too early to bring people back? Is that, but we need people? Is this going to be sustainable? So there's all of those challenges as a business owner that you have to sort of run through as well to make sure that you're running the business in the best way that you can to set it up for success. But yeah, I mean, the market has just been really buoyant, and I've been getting sort of feedback from lots of other firms of surveyors, estate agents and solicitors and brokers that we work closely with, and they're all experiencing the same positivity in the marketplace.
And how have you been able to manage the demand during this time, since the market reopened, especially with the restrictions that have been posed in terms of social distancing?
Yeah, so we have quite good capacity. The majority of the demand that we have is actually from private home buyers. So people who are looking for home buyer reports, building surveys, people who have short leases on their flats looking to extend their leases. And we've had pretty much zero inquiries from the large corporate panels who distribute the mortgage-driven valuation work. They're obviously keeping that to themselves, and they have obviously issues that they have to deal with themselves. So we've been able to shift the capacity that would normally service the lender market and focus that into the other customers that are coming calling. So we're able to service the instructions very quickly, and the capacity is there for that. There is definitely more administration that's required. So there are more conversations that we need to have with the homeowner. So we have strict processes in place that we have to follow when we're going into people's homes. But there's also the conversations around how do you articulate that to the homeowner, because the homeowner isn't often your client, the person that's buying their home is. And the estate agents typically don't want you to communicate with that buyer. They sort of stand in the middle. So now we have to sort of have permission to talk to the home buyer. And we're finding that most people are committed to moving, so they're happy to allow us access. But where we are finding problems are where the property that's being sold is tenanted, and the tenants have been self-isolating themselves, and for them to have somebody coming into their home when they've got no skin in the game, they've got no reason to want to sell the property. So we do find difficulties in that space. And then the property inspections are quite, they're okay actually, because we're forewarning people, and everybody understands that social distancing is required. So we're not finding any pushback. People are just really happy that we're dealing with things in a responsible way. So they're giving us the freedom to continue on with our surveys in a normal way, and the PPE is there.
Make things slower, sorry.
You tend to find that you're collecting the majority of the information in the property in a different way. So whereas you might sort of hang around and find a problem, and then you'll start to analyse it, write it in the report, and spend a bit of time. You might have a cup of tea, have a chat. I mean, those sort of aspects of the inspection are not there anymore. And so you're focused more on finding the information that you need whilst you're in the property, as diligently as you can, as quickly as you can, and then you leave the property. So we're finding that we're in the property for less time, but we're outside the property for a longer time. So we're sort of sitting in the car writing up aspects that we found in the property, just sort of giving ourselves the freedom and giving the homeowner the freedom, so that we're distancing ourselves.
Yeah.
Without being rude. It's really weird going up to someone's house and not being able to shake hands and say hi. It's like, hi, I can't touch you, but hi.
Thanks.
Yeah. And I can't have a cup of tea either, because you're not supposed to drink out of people's mugs. So yeah,
you bring your own flask.
Yeah, exactly that.
You've talked about the kind of, since the market's reopened and you've been able to do the full inspections, which you would have done previously, but do you believe that remote valuations, which happens, which became more of a thing during this time, which it was needed, do you think it will become more integral in the market, even post-crisis?
Yeah, I think so. I think that obviously the lenders have been pushing towards the AVM model, the automated valuation model, for quite some time, but that obviously has issues in the current market where there's lack of transactions. Those AVM confidence scores are not as accurate as they once were. So to have a triage and to have a blend of surveyor and AVM together doing a desktop valuation, I think is the perfect way to properly risk assess those low risk jobs, essentially. And there's so many more data sets now that are available, and technology has really rapidly reacted to coronavirus, and I think it's pulled forward everyone's workload. I think that everything that was in a pipeline has all been brought forward. So we can do desktop valuations now, bringing in flood risk, subsidence risk, any insurance claims on a property in the past. All of this information is now just instantly available, so it gives you a lot more accurate desktop valuation. We've also developed, in conjunction with a company, Propria, a way for homeowners themselves to take photographs of their property. So we have time-stamped, geotagged photographs that landlords can take of the landlord stock, or homeowners can take of their property, to upload it to the surveyor straight away. So we found that desktop valuations are great where people have bought the property recently and they haven't done much to it. But if someone's bought a property and they've done a loft conversion or an extension, or they've fully refurbished it, that information isn't available online. So when you're doing a desktop valuation, it's difficult to be able to quantify that within a valuation. So by giving the homeowner the ability to provide you with the most up-to-date information on their home, but also from a risk management perspective, having it geotagged and time-stamped, it gives the lender confidence as well that the information that's being provided can be relied upon.
That's great technology.
Yeah, so it's just getting the lenders to have the confidence to make that part of their business as usual coming into the new world.
Out of interest, how many specialist lenders have wanted to take that up?
There's been quite a lot of interest from some of the I suppose the specialist lender panel managers that we're talking to. So they will start to slowly distribute it out into lenders that want to run with it. Nationwide Building Society are the main user of the app at the moment, that have been piloting it through this process, and they've been really enjoying working with it. So it's just sort of spreading the word, and risk managers and underwriters seeing the product, understanding how it can de-risk the valuation and the loan book, for people to then have the confidence to start to use it. But yeah, there are a few in the pipeline that are looking to come on board.
Fantastic. You've obviously mentioned quite a few of the different valuation options that you've expanded into. What have you seen the most demand for from lenders, particularly in the bridging and the commercial finance space, and why do you think this is?
So we've seen quite a lot of people asking for desktop valuations. So obviously there needs to be an ability to still lend money, that the markets still need to move. You also have a lot of people that, particularly developers, where they may be on stage drawdowns, where they've asked to borrow a certain amount of money to also do the building project. So they need to be able to have a surveyor go out to the property to sign off that they've done what they should do, so that the next tranche of money can be released to them. So really it's been remote valuations. We've had quite a few bridging and commercial companies that have tried to be innovative themselves as well by sending us over videos, getting their mortgage applicants to go and do a video of the property, send the video to us on a Dropbox. We've also done WhatsApp videos as well, where we do a WhatsApp video call with the homeowner so they can take us around their property. So there's been a few different sort of techniques that have been introduced.
Apart from the geotagging pictures, which you mentioned earlier, and that tool, how else can risk be mitigated for lenders when you are valuing remotely? As you said, that's been quite high in demand from bridging commercial lenders.
It's providing the accurate information to the surveyor up front. So making sure that there is information available online to qualify the property as being suitable for a desktop valuation. And as I say, if changes have been made to the property, then making sure that all of that information is provided as part of the application so that the surveyor can see the property correctly as it is today. And it's the quality of the data sets the desktop valuation up for ultimate success. If there's not a lot of data, then you can't help but err on the side of caution, because you can have a look at the front of a building and some old photographs that may be 3 or 4 years old, and then you have to assume that it's 3 or 4 years worse now than it was then. Whereas actually, if they've moved into that home and they've loved it and they've revamped it and now it's loads better, then you don't know that unless you're given that information. So you have to assume the worst, essentially. So it's the quality of the data that is the most important thing to be able to give an accurate valuation.
And can commercial property be valued remotely, or are they expecting a full physical valuation reports for those types of assets?
They can be valued remotely. We're on HSBC's commercial panel, and we'd agreed with them to go out and to do sort of external inspections and where appropriate to be able to do desktop valuations. But the demand really in the commercial space slowed up, really. I think that businesses were focusing on other things rather than perhaps raising finance against their assets. But there are technologies out there that we use. So Matterports, for example, is a fantastic way of us being able to go out, send virtual reality cameras around a building so that the surveyor can then walk through the space. It produces full RICS, fully measured plans, and creates a pack then that the surveyor can rely upon. So there are ways around doing remote valuations on commercial properties, but it relies on that information being available already. So yeah, you can do desktop valuations on commercial space, but again, it's down to then the accuracy of the information that's provided. So occupational leases, and I think part of what a surveyor does as well is that you don't just do the valuation, you're also the eyes and the ears of the lender. So if you get to a property and actually it's not being used, let's say it's a buy-to-let application, and you get there and there are locks on every single door, and it's like, hang on a minute, this is a HMO, this is not a buy-to-let property. So we do more than the valuation. We can also spot mortgage fraud, and we can also spot where people have changed up the property so that you can, I suppose, mitigate risk in another way as well.
Sure. This one's probably quite a difficult question right now because the market is so uncertain, but what outlook do you personally have on both the commercial and the residential property markets in terms of pricing and value based on what you've seen so far?
Yeah, it's a difficult one to call. I don't have a crystal ball. If I did, then I would be mega minted. So I think that really right now there is phenomenal demand. So Rightmove, they posted that they've had their busiest days on Rightmove. They're saying that property prices are increasing, rental is increasing. It's interesting to see the type of property that people are searching for. So they're not searching for studio flats and 1-bedroom flats. They're looking for 2-bedroom houses with gardens. Everyone wants outside space now. I think anyone that was cooped up in a flat with no outside space will be driving themselves mad and just, wants a balcony, wants a garden. So I think demand is shifting into more family friendly property. I think that values at the minute look like they are increasing. We've just had an announcement today that the government are releasing £100 billion of quantitative easing out. So that cash is obviously going to be coming out and made available for loans. So 0.1% interest rates, 100 billion coming, huge demand for property, all indicates that prices are going to go one way, and that's in an upward trajectory. But we have to be realistic that we don't know yet how many people are going to be coming back from furlough and how many jobs are still going to be there. But I had an interesting statistic that one of the legal and general departments had said that about 48% of people who are on furlough are in the age range of 18 to 24. So they're not in the mortgage market anyway. Yeah. So that leaves half of the people potentially who are on furlough that would be a target market for home buyers. But people don't just buy property based on income, and that, you know, it's an emotive decision as well. So I think that people have made lifetime decisions. So you're kind of ripping up the rule book, really, and this is like a new psychology. People are waking up and realizing, hang on a minute, I've just been work. There is actually a life I need to live, and I want to go and live somewhere nice. So I think that prices, as long as jobs are going to be sustainable, and prices look good. But the Savills report this week suggested 7.5% drop this year in UK house prices. But I think on average, I think in London they were saying 8% rise next year. So in a 12-month period, or maybe 18-month period, whatever losses may come in the short term, it should bounce back and even itself out in the long term, and rents are set to do the same. So I don't think it's all doom and gloom. And then in the commercial space, I think it's a little bit difficult in the commercial space. That retail is struggling anyway. But one interesting report from Deloitte suggested that the larger firms in the city are looking to reduce the floor area of offices that they occupy, because they're going to go to more of a home worker model. Yeah. So one thing that I really hope, in a way, is that there will be a redistribution of the wealth. So if everybody's going into Canary Wharf or into the West End on the tube and the train to go to work every day, and in the morning they're grabbing their £8 Pret with their coffee and their whatever they're having, and then they'll be going to spend £10 to £20 on lunch every day. Well, all of a sudden that money's not being spent in the retail in the city. But if we're working from home, then hopefully we'll still want to continue to go out, but we'll start to spend that money in the local high streets. So there could be a little bit of resurgence in the next sort of maybe 24 months in the high streets, where we're going back out and we are shopping local, and so that could set a good potentially a reverse trend for retail. Industrial, I think, is obviously it's going to be very strong, because people are going to need big sheds to store. If the internet is the way that we all continue to buy, then people won't need shop fronts, but they'll need distribution buildings, and they'll need industrial buildings to store their products in. And offices, really, I think offices can go two ways. So people say that obviously you need to reduce the floor space if you've got home workers, but you need to more than like quadruple the amount of space that you've got for the employees. If you've got to give everyone more space now to work, you can't have someone sat right next to me anymore, like you rack them and stack them into call centres and things. You've got to give everyone space. You've got to increase the floor area that you've got. So in one hand, there might be some people looking to trim what they've got, but you'll find other companies that will thrive through this, and they'll want to increase the floor area that they've got. So I think that investment side of things, if you've got a really good tenant in a building who've got a good business model, I think that the value of those investment properties will definitely increase, because you've got interest rates at 0.1%. You've got the stock market every day is all over the place. Go and buy yourself a commercial investment property where you've got 10 years of rental income that's going to be coming through into your bank account, and that's quite a sustainable investment. And in 10 years' time, hopefully all of this will have come out of the wash, and the property will be worth what it would be worth anyway.
Made some great points there. Thanks for that.
No problem.
And just for any of our readers who might not know who you are, how did you get into the industry?
Oh, crikey. Well, if I'm honest, I was 16 and I was in my careers advisor room saying, what do you want to do? And I was like, I don't know, maybe go into farming. Because I grew up in Wales.
Right.
So, and then she said, well, what about property? And I said, well, what about property? And I just sort of just rolled from there, really. And after finishing my degree, I got a job in South London, in Surrey, more Surrey than South London, doing commercial, residential and development valuations, predominantly for HSBC Bank. And then I moved up to Cushman & Wakefield in the West End, sort of the second largest firm in the world. And then from there, decided to branch out, not on my own, but with my business partner at the time, Mrs. Baldwin.
Amazing. And what would you be doing if you weren't in property? If you didn't make that?
Well, I'd be a farmer, wouldn't I? So I'll probably have bigger guns. Maybe have the same lockdown hair, but yeah, I think that that was my plan. That if I didn't get onto the course at university in Bristol, then I was going to go down the farming route that most of my friends did from school. But yeah, I don't look back. But maybe I will go full circle. And now that I've been a surveyor and I've made the money to be able to go home and buy a farm now rather than being a rental farmer.
Amazing. Thank you so much for your time.
No problem.